Hey guys, welcome back to the channel. Today we are going to talk about the wheel strategy. If you're unfamiliar with that wheel strategy, it's a pretty popular strategy that beginners can, once they've kind of accomplished mastering covered calls, they can get into the wheel strategy. And I'll try to explain the best that I can in plain English what the wheel strategy is. You know, I understand that people that are new to options, a lot of this stuff sounds very foreign, right? I've been there, I get it. But it is very difficult to really portray this in a very plain English manner. Because once you're in it and you get the lingo and you know, some things are opposite and you get used to it, but in the beginning it's extremely confusing, and I get that. So I'll try to make this as simple as possible, so bear with me if I stumble a little bit. Now, the wheel strategy is essentially selling a cash secured put in anticipation of getting the shares assigned to you. Okay. And then if those shares are assigned to you, you wheel around and you sell a covered call against those shares, right? I like to do weeklies if I'm going to do a wheel. That's just my preference. You can do monthlies if you'd like, but it's just my preference. I like to maximize the cash flow of my investments. So what I'm looking at on the screen today is one of the easiest ones to do, and that's XLF. And XLF is the Spider Sector ETF for the financial sector. And what I like about all the spiders is they all have weekly options, except for XLRE, which is the real estate sector. Now, to set up a wheel strategy, the first thing you would do is sell the cash secured put, right? So over here is the put side if you're looking at this option chain, and over here is the call side, and over here is the date at which those calls and puts expire. So to start off a wheel strategy, you either sell an at the money. If it's at 34.57, 34.50 is pretty much at the money. So you would sell that, right? And you would collect something in the middle, because the bid, and you would usually collect somewhere in the middle of the bid and ask. So the bid, these are people looking to buy contracts, and the ask is people looking to sell contracts. So actually, this is you on the side looking to sell a put contract on XLF at 34.50 for an expiration date of March 26 of 2021. Now, I'm not doing this during market hours, so none of these numbers are moving. Usually these numbers are moving all over the place, but you'd probably get somewhere between 55 and 71 cents. Let's just round it off and say you get 60 cents for selling that contract. Now, when you sell that contract, you have the obligation to the buyer of that contract to buy 100 shares of XLF at 34.50 on March 26. That's only if at the time of expiration that the stock price falls below 34, falls at or to 34.50 or below. So if it falls below 34, if it stops at 34.50, you would have to buy and fulfill that contract that you sold to the buyer, and you would own 100 shares of XLF at 34.50. So what you would do at that point is you would wheel around to the call side after you've received those shares, and you would sell a at the money or out of the money, slightly out of the money call, right? So this is the call side, and it's the same thing. These are the people looking to buy the bid. They're looking to buy call contracts, and the ask side, they're looking to sell call contracts. So over here, you'd get somewhere between 29 and 38 cents. Let's just say you get 35 cents. Now, when I say 35 cents, you're not getting 35 cents. You have to times that by 100. So these prices are all per share. So all contracts are traded in 100 share lots. So each contract represents 100 shares. So you would get, let's say you get that for 35 cents, that'd be $35. Now, if the share price stays below $35 at the expiration date that you sold it at, then you get to keep that premium that you sold it for, and then you get to do it all over again. Okay. Now, if the price goes above, say it goes to $35.50, well, you have the obligation to sell those shares at expiration date for $35 to the buyer of that contract. So now you don't have any shares. You would have $3,500. Now you would take that money and you would secure your next cash secured put. Let's say it's at $35.50, and now you would sell at the money or slightly out of the money cash secured put for the next week. And let's say you get 88. I mean, these numbers aren't accurate, but you just repeat the process all over again. But you have to be willing. One of the drawbacks to this strategy is some people do this just to run the wheel, and sometimes they may pick bad stocks to do it with, right? You have to be willing to own these stocks regardless of whatever premium you get. So you have to be willing to own XLF at $34.50, because if it were to just drop all the way to $30, you may not be able, you're still going to be on the hook for it at $34.50, even though it dropped to 30, right? But you can just crawl your way out of it by selling covered calls, above your cost basis. That's really important. So that's why I don't really talk about, I have some other ETFs over here on the side that you can get a lot more premium out of the wheel strategy, but you take on a lot more risk as well. Like, for instance, the MJ sector, right? They have weekly options, and the premiums are very good, but this could be a very volatile ETF to get into and run this with. So you have to be comfortable with what you're doing this with. If you're doing single stocks, T is actually a good one to do this with. Low volatility, nice way to get started in this, to learn how to do the wheel strategy and learn more about how cash secured puts work. So if you're going to sell a cash secured put, you might as well sell it on something that you actually want to own. So that's the XLF. Another one that you could do, it's a little bit cheaper, is Jets. I actually like Jets at the moment for this, only because I think Jets, which is the I don't know who sponsors it, but it's an airline ETF basically. I actually like this because I think as our country opens up even more and more and more, that people are going to be flying, and I think there's some upside here. But that's my opinion. I don't have any position in this, but like you can see, it's at $28.71. You can do the same thing. You can sell this $28.50 at 11 days out, and you'll collect about $85 for that for 11 days. And if it doesn't go below $28.50, you keep that $85. But if it does go below $28.50, then you would buy 100 shares at $28.50. then you would turn around and wheel it back and sell covered calls to keep collecting income. So that's Jets. What other one? If you want to do monthlies, these aren't suggestions. These are just, cheap ways to get into the wheel strategy. QQQJ could be one. It's kind of I did a video on QQQJ, and I'll link that below, but it's basically the next generation of NASDAQ 100 stocks. So there's the QQQ, and these are like the QQQ babies, if you want to call it that. So you can do that, monthlies, 32 days out. You can sell a 33 strike on QQQJ, collect about $90 for that 32 days. And then if you get assigned, you can roll that back over and start selling covered calls. Let's see, what's another one? I think that's it. I covered the MJ, the Jets, the QQQJ, and the XLF. I think that would cover it. Unfortunately, I wish there were a cheaper version of the S&P 500. I think that would be a good way to go. But you would need a lot of money if you're doing actual cash secured puts for, say, a SPY. Let's see. Let's look at SPY. See, to do SPYs, is it going to do it? Sometimes late at night. There it goes. So to do the SPY, you would need a lot of money. See, it's going for $396. You'll times that by 100, right? If you're doing straight cash secured puts, it gets quite expensive to trade the S&P 500. But, some of these little ones are okay. I hope the wheel strategy was explained a little bit better here. And, I hope that you would look at some of these, just if you're going to get into it, just make sure that you're willing to own that ETF, right? Or that stock. Like I said, T is a good one, to wheel with, or XLF. XLF has kind of ran up quite a bit here lately. QQQJ is not too bad. Jets isn't too bad. I think Jets has some upside. So you don't want to just do a wheel strategy just to do a wheel strategy. That's kind of my point. So I hope that helps some. If it didn't, let me know. But if it did, let me know. Comment down below if you have any questions. I'll try to do more of these that try to explain more of this stuff in plain English, because I know that there's a need out there for that, without getting into the deltas and the thetas and the Greeks and time decay and all that stuff. I know that gets, super confusing. So if you found this helpful, let me know. Like, share, subscribe, do all that good stuff. Check the pinned comment down below. You guys have a great day, and we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.